Hello, everybody, and welcome to episode 42 of Crossing the Line with Greg Heym. This is a special one, but aren't they all special? Not only can we honor Jackie Robinson with the number 42, but we're back after Greg had to take a week off to get his hip replaced. So, I'm a little more metal than I was the last time we spoke, but we're just going with it.
I was going to ask you, we could start there. We haven't had a chance to catch up yet. How are you feeling?
They warn you about how you're going to feel. And one of the first things they tell you is it's going to feel like there's a foreign object in your body because there's a foreign object in your body. So
were they accurate?
The pain hurts, doesn't it always? But I'm way ahead of schedule, they tell me, in terms of what I'm doing. I haven't been following all the directions. Like the walker lasted about 20 minutes before I got rid of that. And I'm barely using the cane these days. So I'm going my father's method of rehab, which is I'm just going to do what I want and hope it works out okay in the morning. It seemed to work for him. But then again, if I was in the shape my father was in, I wouldn't need a new hip. So maybe we'll follow most of the directions. It's a bummer now.
You look great, Greg.
Well, thank you. I have lost a little bit of weight, which is, I wouldn't recommend surgery as a means to do that, but it's, it's stuck being home. I can't drive. I got my Tesla sitting there. So I go outside and I sit next to it and we talk to each other since I missed my car. So
I'm sure the Tesla can actually talk back to you too.
It probably would have some smart aleck things to say if Elon programs it. So how you been? Been a couple of weeks since I've seen you. How's everything going?
Everything's been good. I was in Austin last week. We had our company's annual conference out there, and it was great. It's always good to connect with people within your own industry and different markets and hear what people are doing. And it was great. Austin's a great city, especially for someone like you who loves music. It's such a great
South by
music
Southwest.
city.
That's like a bucket list thing.
And
obviously as a huge Stevie Ray Vaughan fan, so love music that comes out of there. By the way, Scott Nadler, I didn't introduce you, but why should I have to? Mortgage lender extraordinaire from the top retail lender in the nation, CrossCountry Mortgage. And we love anything with cross in it. We love crossing everything. So welcome to the show. And
exactly.
So the last time we did one of these, mortgage rates had just about touched 6%. We were all very happy. It was just 2 weeks ago. We were all excited. And now, not so much. Now they're 6.32% according to the latest Freddie Mac numbers. We'll get into specifics in the sort of second half of the show. And by the way, we are doing the show remote, but I'm in my dining room. I don't know where Scott is, but it looks nice.
In my apartment right now.
Yeah, looks like I want to hang in Scott's place. But, we want to give a shout out to our friends at the Everset for all the work they do. And there is this great new set. And we'll be back there hopefully next week or the week after, as soon as the doc tells me it's okay.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
So anyway, let's talk about so we were touching 6%. We were like, Scott's phone was ringing. And the last 2 weeks, things have gone in a bad direction. So I thought we'd kind of go over step by step what happened. And some of it's obvious, some of it may not be as obvious. It all started, the Freddie Mac numbers come out on Thursday, right, of every week. And what comes out on the first Friday of every month is the jobs report. So it all started with the September jobs report, which was a complete blowaway number. I mean, every way you looked at that report, it was phenomenal. Upward revisions to prior months, something we hadn't seen in a very long time. And, careful what you wish for, because right away that rattled the bond markets. And, we also found out job openings are going up. Nobody saw that one coming. Unemployment claims is still pretty low. So that's good. But right after that report came out, mortgage rates, according to Mortgage News Daily, spiked to over 6.5%. Like that. Um, that's the sensitivity, right, Scott? Any better than or worse than expected news moves markets, doesn't it?
And it's not unexpected that you would see rates go up after the Fed cuts rates. I was looking at a chart through this service called MBS Highway, and they were showing 40 years of data of every time the Fed cuts rates, that you do see an initial spike in mortgage rates, especially in the 10-year Treasury. And then within that rate cutting cycle, you see it start to drop down. And there can be many reasons for that, but I think part of it is investor psychology. People were purchasing bonds leading up to the Fed starting to cut mortgage rates. So there was an anticipation that that was going to happen. And I think in addition to that, investors feeling that it's decreasing the chance of a recession, that the Fed is willing to start cutting rates now, you'll start to see money flow into the stock market and away from the bond market.
Right.
So, those are some of the things that maybe are not glaring and obvious that we're seeing happening in the market. But I'm also focusing on some of the things that the Fed members have been saying.
Well, this goes to
by and
something
large,
out, like literally right before the jobs report came out.
Yeah.
The chairman, Jerome Powell, actually is trying to prepare people, right? And he basically said, because he had to say it in Fed speak, but don't expect a 50 basis point cut every time we meet. Like, don't even think about that. Like, we reserve the right to do it 25 basis points at a time. And like you said, you got to think of the yield curve in this and how the short end and the long end behave differently. And by cutting rates, you're stoking inflation down the line. Whether or not it's going to be a problem, we'll see when we get there. But that's putting a little more weight on one end of the seesaw, right? Which is going to bring that other end up. And, a lot of the stuff is priced in. This was, going 50 was a bit of a surprise, but we knew they were going to cut. So, yeah, I think it is. And like you said, the Fed governors say things and sometimes they don't agree and it confuses. And a more transparent Fed isn't always the best thing, I think, in times like this.
I think by and large, based on what I've been reading from the Fed comments, is they're somewhat unfazed by this latest jobs report that came out. They want to see more data. They don't know if this is an outlier. They want to, every jobs report we see, there are revisions one way or another. So we are still in this wait and see mode. They're not fazed by this blockbuster report that came out. So I think Fed Chairman Williams said they're still focused on that dot plot. Like their plans haven't deviated too far from where their dot plot was when they made the Fed announcement, when they cut rates almost a month ago at this point. So, but yeah, it was a great report by every metric.
They're like an airline pilot, right? They plot a course to go somewhere, and unless the weather gets really, really bad, they stay on that path. And I understand.
Speaking of which, so we're flying to Austin, and very smooth flight. We're about to land. We put our seats forward, our trays up, and all that. We're preparing to land, and we're descending, and then immediately we pop back up. Like we all felt it, and no announcement for about 45 seconds. So we're just sitting there like, what the heck just happened? And then very calmly, the pilot comes on that they're not quite ready for us to land yet. So we're doing a little loop around and we'll be landing shortly. But yeah, that was there were some scared faces on that flight in those 45 seconds where we weren't quite sure.
Well, they can't quite tell you what to do. I get what they're doing when they're pulling up real quick, does it? You got to give them a minute or so.
I was next to a pilot. So he was not fazed at all, and therefore I was not fazed either.
Well, you got the good seat. See, I
got the good seat, exactly.
When you're a mortgage lender. So then we have last week where the PI brothers show up, right? And you see consumer price index comes out above expectations, which we never want to hear when it comes to inflation data. That does not help mortgage rates. It's not going to lead the Fed to think about 50 basis points even for a while. But the interesting thing in it is really being over 75% of the monthly increase in consumer prices was in two categories: shelter, or housing as normal people call it, and food. And that's why the Fed can look at this and say, well, you know what? Food is food. That's not a core in the core number. And the housing numbers we know are not that accurate because of the 6-month lag and when these things change when we follow up. So, I mean, then you could flip and say, well, look, if energy prices weren't coming down so much, the headline number would be much higher than it is. And with turmoil in the Middle East sort of picking up, you see oil is already going up again. Who knows what to expect. PPI at least came in as expected, so we can relax. And again, nobody really pays attention to PPI unless they say something.
Right.
It's like the little baby sister that you don't notice until she really throws a fit, and then it's like, okay, what do you want now? And
also, I think one of the Fed members, maybe it was Williams also, who acknowledged the lag in housing. And I know we've spoken about that here, and you've spoken about that extensively, but that is something that is being acknowledged also.
That's why they ignore it. That's why, look, core inflation, you don't want that running higher than the headline number because it takes longer to come down. But when you can identify the root cause of it, and we know that housing prices are not going to keep rising at the pace that they were, at least not yet. That can change. But, this is a problem. They're always 6 months or more behind the curve. So then we got consumer sentiment at the end of last week, and it was negative. It went down, I mean. And it'd be basically due to this inflation data. Like, people have had it with inflation. I don't know how to say that better. Like, it's been over 2 years of pain on the American consumer. And again, as we like to point out, we don't have deflation, we have disinflation. The rate's coming down, but it's still too high. And guess what else is coming down? The rate of wage increases, although in September it was higher than expected, of course, because September was the greatest month of ever. And the funny thing is, September is usually a bad month. It's the worst month for stocks historically. Oh, and one other thing to point out, like, this data over the last 2 weeks all sounds bad, right? Inflation higher than expected. We got job growth much higher than expected. It's like, that's not good for rates, which is not good for stocks, which is not good for anything. But by the way, the S&P 500 and the Dow ended last week at record highs. So, as Alfred E. Newman would say, what me worry, right? It's all about the stock market, Scott, right? Isn't it?
It is. Yeah, for sure. And I think, one of the things to think about also when it comes to the jobs report is that seasonal adjustment for teachers. This is the time of year where schools go back in session and teachers start working again. And normally, I think if you look at the September report of 2023, that seasonal adjustment was something like 38%. And this year was something like 79%. So there was a big adjustment there, or not as big of an adjustment there, which is somewhat of a head scratcher as well. I wasn't sure why that was.
We have 2 hurricanes that, are going to lead to temporary, impacts, hopefully temporary, on this data as well. So, yeah, you have normal market factors, then you have natural disasters, and then you have BLS economists and their sampling and their adjustments. And the one thing that we've seen in so much of the data that we look at is the regular seasonal patterns are out the window. And, and that leads to 818,000 jobs going bye-bye, right? In the year ending March. So it's
something else I saw that I found interesting was the NFIB, so the National Federation of Independent Businesses. They have these different surveys, and their uncertainty index was the highest it's been on record. So really since 1975 is when they've been tracking this. So it's the highest uncertainty index. And I was thinking when I saw that, I was thinking back to our conversation about Gen Zers and how they have access to so much information that's out there that it can cause people to react a certain way or think that things are so uncertain because they are flooded and inundated with so much information. So I was curious to get your thoughts on that too.
Well, I mean, we always talk about it in housing, right? People want certainty when they buy, and we're talking a month out from an election, so obviously 2 wars going on. But when do we have certainty? I think the things that we're worried about, well, the election is hopefully going to be decided in a month. Who knows? But that will go away, and people can go forward with their plans. I mean, we're always going to live. Look right here in New York City, right? There's a lot of uncertainty about our government right now here in the city. A lot going on there. We'll see what ultimately happens. So I mean, volatility by itself is unnerving, but it doesn't mean that we're headed for disaster. If you look back to COVID and how quickly the economy was able to rebound there,
Right.
I think that plus us economists always look on the bright side, don't I? We're known for that. I'm Mr. Blue Sky. I had to give a shout out to ELO on their final tour, although I didn't see them, but I heard they were decent. Look, it's always going to be that way. I'm not going to.
You can always be certain there's going to be uncertainty.
Well, death and taxes are the only certainty that we have, and I think that's something that has to be managed. Getting on a plane is a risk, right? Getting in your car is a risk. Our whole life is risk management, and I think we have to. Again, it all boils down to how I view my job: is make informed decisions. A lot of people call me up and say, "Oh, rates went down a little bit, Greg. Should I lock in? Should I not lock in?" And then it's never that cut and dry. If it was, we'd have Robot Scott on the on the show, and maybe Robot Greg talking to him. I think that you have to understand the upside and the downside to any decision, and then you can go ahead. And there's always risk. Getting married has risk. Having kids, anything you do in life, what college you pick. I mean, you go nuts. This is why I don't have hair anymore. But you have to go and it's an assessment of the risk and understanding what the ramifications of your choices. But when it comes to investing, no matter what you're investing in, it's long term. So your sensitivity to the current risk environment shouldn't dominate your decision, at least in my opinion. But everybody's got. Look, some people like to keep the money in CDs. Some likes to put the money in tech stocks. People have different tolerances.
And those are a lot of the conversations that we have with clients when it comes to the type of program that they're looking for, whether it's a 30-year fix or a 15-year fix or an adjustable rate mortgage. And they're asking for our opinion about, where do we think rates are going to be in 5 years from now? And I'm always like, if I knew that answer, we'd be doing this conversation from my yacht right now. I don't have it. But to your point, if you're going to be in the home for 5, 10, 15 years, then you're less sensitive to that volatility.
It's like my hip, right? There's no clear cut. They look at an x-ray and say, look, you have bone on bone over here. But my surgeon wouldn't say to do it or not do it. He says you have to make that decision. Now, some people say he's just punting it over to you, but then it gives me a chance to ask questions. Like, if I do it now, am I jumping the gun? Can I get more injections? Should I wait and see how they do? And, am I being too rash and saying, just get it out of me now? So I had a lot of conversations. My wife just went through a hip replacement, so I had plenty of information, and I feel very comfortable, although not always when it's hurting me. But all right, so we're going to talk about the current rate environment, the current housing market, when we get back from this very important message from our good friends at CrossCountry Mortgage.
Calling all real estate investors. I'm Scott Nadler, VP of Mortgage Lending at CrossCountry Mortgage, and it's time to level up your portfolio. Whether you're a seasoned pro or making your first investment, I'll find the right financing to maximize your returns. From single-family homes to multi-unit properties, I'm here to help you crush your investment goals. Ready to grow? Let's connect today and make it happen.
And we're back, my best bud, Scott Nadler. And, we've been talking about, you go away for 2 weeks and then all hell breaks loose with mortgage rates. So again, it's all.
By the way, I feel like that happens every time we have a conference. We have a mortgage conference, and either rates skyrocket, they plummet, something happens. So we need to stop. We need to change the time that we have these conferences.
When the Fed has their things, when they go to Jackson Hole, right. I get it. It's my fault. Good news is I only have one other hip that can be replaced. So, but there are other joints in my body that aren't doing so well. So we'll keep you posted on those. We have like volatility indexes. We'll have like Greg joint indexes so we can see how bad I am.
We need that. The index, we didn't know that we all needed.
Well, you don't have it. That's why you need it, as Yogi Berra used to say. All right. So, we've seen this movement in rates. You're going to have these moments, like you said, whether it's a better than expected jobs report, a higher than expected inflation report, or you have them both within a week of each other, like that stuff is going to happen. But where do you feel we are right now? What's the latest up to the minute info you want to give us on rates? Are you still getting calls? Because I can tell you from the data here in Manhattan, well, I'm in Wanto right now, but when I'm working, I remote into Manhattan. So activity is pretty good, and year-over-year gains are still pretty nice. So what are you seeing right now in terms of how busy you are, and where do you think rates are right now and where they might be in the next couple of days?
Yeah, so activity has definitely picked up. This has been a very busy month. For us, there are kind of three categories that we look at. Number one, there's the Fannie and Freddie type loans. So these are non-jumbo loans that get sold to Fannie Mae and Freddie Mac. Those types of loans are very sensitive to what's happening in the market. You will see fluctuations in the rates very quickly. And again, rates always go up very quickly. They go down very slowly. Then there's the jumbo market. Jumbo markets also move in accordance with what's happening in the market, but not nearly to the degree or as quickly as they do for the Fannie and Freddie type loans. Then we also have broker lenders who we operate with. These are credit unions, smaller banks who do not move their rates in accordance with what happens in the market. They're obviously following the market, but we have some lenders who have not moved their rates in 4 months. There has been a lot of activity in the market, but they have not moved their rates at all. Part of it is supply and demand. As activity picks up, they may raise their rates irrespective of what's happening in the market. And the reverse is also true. If they're starving for more business, they may lower their rates. So for someone like us, we have our own banking platform where we can lend, or we can act as this broker intermediary between another institution. So when you see these quick changes in the market, that forces us to potentially pivot and look at a different option for a particular loan because their rates haven't moved. Now, there are downsides to that because you're looking at another lender's process. There are guidelines. So you have to make sure that the loan fits within their portfolio and what they're actually looking for. But when it comes to rates, those are kind of the three categories that we're looking at for each loan for each client that we're ultimately talking to.
Now, when you see something like what happened when the jobs report came out, now rates are rising almost by the minute, it seemed. Does your phone start ringing off the hook saying, can I still lock? Can I still lock? And then do you see that sense of urgency with buyers, or is it we haven't hit that level yet?
Yeah. So, typically if we're ahead of things, we want to get ahead of our clients and let them know exactly where things are. And a lot of it also has to do with timing. When is someone's loan closing? We're in New York. There are a lot of co-ops. We're always at the mercy of a co-op board. We can't close until a co-op board approves someone. Right. So if someone's not closing until January, let's say, then we're not really in a rush right now to lock someone's rate in. If someone's closing within 30 days, then we need to have a conversation and say, hey, we were at X rate, now it's 0.25% higher. Do we want to lock something in right now and prevent it from going in higher? Or do we want to wait and play the market a bit? And those are the conversations, those honest conversations that we're having with clients, but most of our clients are protected right now.
Well, and how does the stock market play into this? Because, a lot of people are asking me now that rates have come down, maybe people will borrow more money, or, maybe they'll get more active in the market. And my counter to that is, well, you're forgetting that the stock market looks really attractive right now, right? Because when yields go down, where are you going to put your money? And this is what can lead to what Greenspan called irrational exuberance sometimes.
I think we're having more and more conversations with clients who were initially thinking about purchasing homes in cash, who now do not want to liquidate, or those who were thinking about putting 50% down, who now want to put 30% down. So those are the types of conversations. I spoke to a financial advisor last week who has a high net worth client looking to buy a $2 million home. They were going to pay for it in cash. But they thought, why don't we take a mortgage so we don't liquidate all of your asset holdings or a percentage of your asset holdings and take a loan. And when we went through the numbers and see kind of what they're making in the market versus their rate in the sixes, it made sense. So those, we're when the market's doing really well, like it is, those are some of the conversations that we're having.
Well, it's always great to make an investment with somebody else's money, right? That's how people view real estate. Look, when I got my Tesla, they were offering 1.99% over 6 years.
You have a Tesla?
I love my Tesla. I never mention it, right? No, but that's the thing where it's like, why would I put anything down when you're going to offer me 1.99% in this environment? I guess the higher you go up the net worth, the more complicated the decision gets, right? For the average American, it's a simpler decision and it doesn't really necessarily change much. But that's the concern. We all want lower rates, and but then people will take some of that money and say, well, maybe not real estate just yet. Maybe stocks. Let's keep riding this wave, which has been an incredible wave. It seems to be immune to any bad news for a prolonged period of time.
Right.
So, we issued our quarterly reports for all the New York City areas, and we don't see any big changes in closings year over year yet, but the momentum in Manhattan is building. Now, Manhattan has behaved much differently than the outer boroughs, which, like the rest of the country, were open pretty fast after COVID and benefited from an exodus of people from Manhattan to the outer boroughs and obviously the suburbs. So, I think Manhattan is really starting to find its footing after only knowing the worst market ever, the best market ever, the almost worst market ever, and now we're kind of headed into, and like we've talked about, and I'd be interested to hear if you still have these conversations, people waiting for rates to come down are risking what is low supply in many places getting even lower and raising prices. Have those conversations changed? Are you getting more of them now? Because, even the national numbers weren't great. Existing home sales kind of ticked up, and in August, it wasn't like the greatest number ever. The pending home sales I meant, but it's just what are you hearing? What's the resistance at this point more about?
It's funny, on the refinance side of things, there were a good amount of clients that were eligible to refinance that waited because they were waiting for rates to go down a little bit further, and then they started to tick up. So now they lost that window, and now we don't know when it's going to go back there. On the purchase side, though, look, we have a large group of clients that are pre-approved, and the overwhelming majority of them are actively looking. They're still looking. They're not, it's rates are still down from where they were 6 months ago. So I think those people are still looking. Now, if we see a persistent increase in rates, I'm sure things will slow down a little bit. But this is a blip. It's very, very quick also. We'll see how long this persists for, but I really haven't seen a drastic change yet. All of our clients who are pre-approved, who are actively looking and shopping, haven't stopped.
Well, look, I think the pent-up demand is there with the economy doing as well as it's done. And again, we're not saying the word recession a lot. Again, we can't rule it out, but even if job growth goes back to the slower trend that we saw prior to September, it's still in pretty decent shape. I think that demand is still there, and all it takes is a couple of buyers, to start the ball rolling, and that inventory. Manhattan right now is sitting just above the 6% level that we consider neutral. So,
Yep.
Manhattan is this close to being a seller's market, something that we thought would never come, so to speak. But again, careful what you wish for. You're saying, oh, there's too much product on the market, we got to get rid of it, and then you get rid of it, and from a brokerage standpoint, you need stuff to sell. So.
Right.
It's just always chasing a moving target that we never seem to just get and spike the football and have a good time with. Speaking of football, sorry about you Giants. It's tough. It's Monday tonight, so the Jets, of course, are on Monday Night Football. And just a comment on that, because it's the end of the show, and I like to...
What a fun time for New York sports, though.
No, but
we'll say that.
Look at tonight. You've got the Jets playing. The Yankees are home. You have the Mets this afternoon, right? The Rangers are at home tonight. So there's a lot going on. But just the joy of being a Jet fan and why they're such a pathetic organization. So
here we go.
You go to London and your quarterback plays terrible, and so you decide you're going to fire your coach, right? So Monday night, the owner of the Jets calls Aaron Rodgers. And according to Aaron Rodgers, just called to check in on him. How you doing, Aaron? Tough game, banged up, you okay? And I'm supposed to believe that Robert Saleh does not come up in that conversation. And then the next day he fires Robert Saleh. Apparently the punter on the team said he found out from a neighbor. So I don't know about the communication issue here, but so you're talking to your quarterback, the guy who's basically in charge.
The headset wasn't working.
Well, maybe the signals came in wrong. I don't know. I can't, it's hard to believe that Woody Johnson is talking to Rodgers and he's not mentioning, by the way, your coach is getting canned tomorrow. I would have thought that would have been really upsetting to Rodgers to find that out, because I would have called Woody and said, why didn't you tell me? But it gets worse from there, right? Then Rodgers' BFF, Nathaniel Hackett, is stripped of play calling duties, but don't worry, he's still the offensive coordinator. So the Jets are paying a head coach not to coach, and they're paying an offensive coordinator not to offensively coordinate.
But here's how quickly things can change. Watch them win tonight.
And they're in first place.
And
they're the most dysfunctional team in first place. But just a final thing on the Jets. Where is Joe Douglas? He's the general manager of the team. Does he have a say in any of this? Is he worried about his job? But yes, it's like the Yankees, right? All year people have been saying Yankees stink. Judge is the only guy hitting and Soto is helping. But when they don't hit, they don't win. What do? They're the best record in the American League. Then they win their series. Now they have a home field advantage.
Mm-hmm.
They're the worst team I've ever seen. It's I know the Mets are capturing all the excitement in New York because it's funny. You wouldn't think bringing Grimace into your team, because Grimace is like a depressed kind of, we don't know what he is. Maybe he's McDonald's version of Eeyore, like the manic depressant. Although I'm not aware if Grimace actually talks. I don't remember that
I don't think so.
As a kid. He's not like a Hamburglar or Mayor McCheese.
No.
But it didn't go so well for the Mets in game one. We'll see what game two holds.
The Knicks won their preseason game against
the T-Wolves, right? So
against the T-Wolves.
Apparently
the Liberty won. I don't know how much we talk about the WNBA here, but why not? May as well.
Hey, any New York team that wins, it happens so rarely that we're all for it here.
Exactly.
Well,
we got to talk about all of it.
I want to thank, as always, Scott Nadler for being here. And I want to thank our sponsors, the Everset, CrossCountry Mortgage, and Canaletto. Sorry, Elvis and the crew there. I won't be eating there today, but that doesn't mean you shouldn't. And located at 208 East 60th Street, serving fantastic Italian cuisine since 1998. Make sure you tell them that I sent you. And you can get my table now because I'm not there. Hopefully we'll be in studio soon. We'll see. And I do appreciate all the support. And thanks to Ray and to Paul to help us getting this remote thing going. They're very particular. We're not, but they have to be. They're the ones making sure we give a good quality video of this. So thanks again, and we will have a show next week. So everybody have a fantastic week, and we'll catch you next week on Crossing the Line.